Today, we will be covering accruals and prepayments. Before I start, I want you to reflect on something. Does cash movement always indicate income earned and expenses incurred? Can you remember when is the point where an expense is incurred or when an income is earned? To refresh your memory, an expense is incurred when the entity received a service or consumes an item. Similarly, an income is earned when the entity provided a service or sold an item. Anyway, I will provide two examples to illustrate what I mean before we answer this question. When you ride the bus or the train, you will typically use an EZ-Link card as a mode of payment. Let's consider the accounting procedure of this. Assume you top up your EZ-Link card by $50 on 1st March. You did not travel for the whole of March, and on 1st April, you took the bus. The journey cost $1, so your card is left with $49. The question is, when did you incur the transport expense? You top up your EZ-Link card on 1st March. That was when payment was made. So does it mean you incurred $50 transport expense on 1st March when you top up your EZ-Link card? Did you receive any service? No. Then what about on 1st April when you took the bus? No cash payment is made on 1st April. You merely tap your card on the fare reader. But the thing is, you have benefited from the bus service. You were transported to your destination. This is when you have incurred transport expense, the time when you received the transport service. Transport expense is incurred on 1st April. This is called a prepaid expense. Prepaid expense is an asset to the entity because it will bring economic benefits to the entity. When the entity prepaid an expense, it can literally sit and wait to receive the service. The entity will enter the following journal entry to record expenses paid in advance. Debit prepaid expense and credit cash by the amount paid. When the entity subsequently receives the service, it will amortize, meaning reduce the value of the prepaid expense. The journal entry is as follows: debit expense and credit prepaid expense by the amount of service received. Looking back at the previous example, on 1st March when payment was made to top up the EZ-Link card, we will debit prepaid expense and credit cash by $50. On 1st April when the transport service was received, we debit expense and credit prepaid expense by $1. The prepaid expense balance becomes $49, the same as the remaining card value. Please note that if the service does not have an explicit value associated with it, you need to calculate the value of service received when amortizing the prepaid expense. For example, let's say I made a $12,000 prepayment for 1 year insurance premium. It was mentioned that 1 year costs $12,000, but it was not explicitly stated how much each month costs. So we need to allocate the prepaid amount to each month using simple calculations. In this case, just take $12,000 divided by 12, which gives us $1,000. The business will recognize $1,000 insurance expense every month. The next example is utilities bill. Assume that you use utilities evenly throughout time, and the utilities bill is $190 per month. The bill needs to be settled on the 25th day of the month. Let's say for the month of January, due to unforeseen circumstances, you delayed the payment to 1st February. For the month of February, you paid the bill on time. So this means you did not pay utility bill for the month of January. And for the month of February, you paid $380. If no payment is made in January, does it mean you did not incur any utilities in January? And does it mean there is a sudden spike in utilities expense in February? Remember that an expense is incurred when you receive a service. Since utilities are used evenly throughout time, clearly, it does not mean you incurred no utilities in January and incurred $380 of utilities in February. Utilities expense each month is $190. If an entity incurs but have not paid an expense, it will recognize a liability called accrued expense. Accrued expense is a liability because it reflects that the entity has not paid for an expense that it has already incurred. The entity needs to pay for the expenses one day. This means there will be an outflow of resources. cash in this case, from the entity when it fulfilled its responsibility to pay for the unpaid expenses. At the end of the financial period or at each month end, the entity needs to check if it has incurred but not yet paid for any expenses. Then, record the following journal entry: debit expense and credit accrued expense by the amount of expense incurred but not yet paid. When the entity has paid for the accrued expense, it will debit accrued expense and credit cash by the amount paid. In the previous example, for the month ending 31st January, you will debit expense and credit accrued expense by $190. On 1st February, when you paid the utility bills for January, you will debit accrued expense and credit cash by $190. Like prepaid expenses, you need to do some simple calculations if the value of the incurred expense is not explicitly stated. We have gone through accruals and prepayments for expenses. Accruals and prepayments apply to income as well, and they work similar to that of an expense. I will briefly go through accruals and prepayments for income. We will start with prepaid income first. Prepaid income occurs when the customer paid in advance before the goods or services was provided to them. This is a liability to the entity because the entity has received the customer's money but has not fulfilled its responsibility to provide goods or services to the customer. It can't take the customer's money and run away. It is obliged to fulfill its performance obligation with the customer, and this involves the entity selling goods or providing services for the customer, depending on what's the agreement with the customer. By selling goods or providing a service for the customer, it represents an outflow of resources from the entity. When the entity receives cash from its customer before the entity fulfills its responsibility, you will debit cash and credit a liability called deposits received, advances from customer, deferred income, unearned income, or any other similar terms. As the entity fulfills its performance obligation, it can recognize income. Here, the entity will debit the liability account and credit income. Accrued income is the reverse of prepaid income. It occurs when the entity has fulfilled its performance obligation by providing goods or services, but it has not received payment from the customer. This is an asset to the entity because it provides economic benefit by giving it the right to collect money from the customer. At the end of each financial period, or at each month end, the entity should check if it has earned any income but not yet collected money from the customer. Then, based on the identified income earned but not yet collected, it will debit accrued income and credit income. When the customer makes payment, the entity will debit cash and credit accrued income. Before I end off, let's revisit the question I posed you at the start of this video. By now, I believe you know the answer to this. No, cash movement does not always indicate income earned and expenses incurred. More importantly, you should remember that an expense is incurred when the entity receives a service or consumes an item, and income is earned when the entity provided a service or sells an item. Cash movement is irrelevant. You should record the expenses or income when incurred or earned, not when cash is paid or received. And this is a quick recap on the accounting treatment of accruals and prepayments as covered in this video.